Money does not enter the economy all at once for everyone. While most people experience inflation as a rising cost of living at the grocery store or gas station, a small group of institutions experiences it as a massive injection of capital. This phenomenon explains why the gap between the wealthy and the working class continues to widen despite periods of economic growth. Understanding this mechanism, known as the Cantillon Effect, reveals the invisible hand that redistributes purchasing power before the average citizen even realizes the money supply has changed. It is the fundamental blueprint for how modern wealth is built and protected in a world of fiat currency. The concept originated with Richard Cantillon, an Irish-French economist who lived during the early 1700s. Cantillon was not just a theorist. He was a banker who navigated the infamous Mississippi Bubble, one of history's first great financial collapses. He noticed that the point of entry for new money determined who gained and who lost. In his 1730 essay, Cantillon argued that if a gold mine were discovered, the owners and workers of that mine would be the first to spend the new gold. They would purchase luxury goods, land, and services at current market prices, benefiting from the immediate increase in their personal supply of wealth. As these early recipients spent their gold, the increased demand would eventually drive up the prices of all goods and services. By the time this new money reached the farmers or laborers at the edge of the economy, the prices of bread and rent had already risen, but their wages had not. This created a hidden tax on those furthest from the source. The latecomers were essentially forced to subsidize the lifestyles of the early recipients because their fixed incomes lost purchasing power before they ever saw a single extra coin. This was the birth of the realization that money is not neutral. Cantillon's observations proved that the distribution of wealth is a matter of sequence. If a central authority increases the money supply by 10%, prices don't instantly rise by 10% across the board. Instead, a specific path is followed, rewarding those at the beginning of the chain. But while gold mines are a relic of the past, the modern version of this effect is far more subtle and operates on a scale of trillions of dollars. The data tells a different story about where that money goes today. In the modern era, the gold mine has been replaced by the central bank. When a central bank like the Federal Reserve engages in quantitative easing, it creates new digital reserves to purchase government bonds and mortgage-backed securities. This process injects liquidity directly into the balance sheets of primary dealers and large commercial banks. These financial institutions are the first recipients of the new money. With billions in fresh liquidity, they can lower interest rates and increase lending. Because they are at the top of the hierarchy, they can invest this capital into stocks, real estate, and corporate debt before the inflationary effects are felt in the consumer market. Commercial banks then use these reserves to issue loans to large corporations and high-net-worth individuals. These entities use the cheap credit to acquire productive assets. For instance, between 2020 and 2021, the M2 money supply in the United States increased by roughly 27%, the largest jump in history. During this period, the first recipients of the capital surge saw the value of their portfolios skyrocket. The S&P 500 recovered and reached new highs within months, even as many small businesses remained shuttered. The proximity to the credit faucet allowed institutional investors to front-run the eventual inflation. The mechanism relies on the fact that prices are sticky. It takes time for the new money to circulate through the hands of contractors, employees, and suppliers. By the time it reaches the general public in the form of slightly higher wages, the cost of a median home has often already increased by a much larger margin. This structural advantage creates a recurring cycle where those with the best access to credit grow their net worth exponentially. But here's where it gets interesting. The impact on the average worker is often delayed but devastating. The Cantillon effect creates a fundamental divergence between the asset economy and the consumer economy. While the Consumer Price Index, or CPI, tracks the price of milk and eggs, it often fails to capture the true inflation occurring in limited supply assets like prime real estate and equities. Data from the Federal Reserve shows that the top 10% of Americans now own approximately 90% of all stocks. When the money supply expands, the demand for these assets surges first, driving prices up. This benefits the asset holder, while the renter or first-time homebuyer finds themselves further behind every year. Consider the relationship between productivity and compensation. Since the early 1970s, productivity has grown nearly 3 times faster than real median wages. Many economists point to the departure from the gold standard in 1971 as a catalyst for the modern Cantillon effect, allowing for unlimited credit expansion. In a system with a constant supply of money, prices would generally fall as technology makes production more efficient. However, in a fiat system, that efficiency is offset by an expanding money supply. The savings from technological progress are often captured by the early recipients of capital rather than the consumer. For example, if a company uses cheap debt to automate its processes, the shareholders see increased dividends and stock buybacks. The employees, meanwhile, face stagnant wages and see the purchasing power of their savings eroded by a 2% or higher annual inflation target set by the central bank. The result is a societal treadmill where the middle class must work harder just to maintain the same standard of living. However, institutional entities have developed a specific playbook to stay on the profitable side of this equation. Large-scale investors and institutions protect their purchasing power by positioning themselves as close to the money source as possible. This is done through the strategic use of low-interest debt to acquire hard or productive assets that tend to rise in value as the currency is devalued. Institutions frequently use leverage, borrowing at a fixed low rate to buy assets that yield a higher return. If a bank can borrow at 3% and buy an apartment complex that appreciates at 5% while generating cash flow, they are effectively using the Cantillon effect to their advantage. In this scenario, inflation actually works in favor of the debtor. As the currency loses value, the real burden of the debt decreases, while the nominal value of the asset and the rent it generates increase. This is why the world's largest corporations often carry billions in debt, even when they have significant cash reserves. Conversely, individuals who keep their wealth in cash or fixed income savings accounts are the primary victims of the Cantillon effect. They are holding the very currency that is being diluted to fund the credit expansion. Over a decade, a consistent 3% inflation rate reduces purchasing power by nearly 25%. Wealthy mentors often emphasize that in a fiat system, savers are losers. This is not a comment on the virtue of saving, but a mathematical reality of the Cantillon effect. To build wealth, many believe one must move from being a consumer of the currency to an owner of the assets the currency is chasing. The disparity isn't a glitch. It is a feature of how modern central banking functions. By recognizing these patterns, one can begin to view the global economy through a much clearer lens. The Cantillon effect proves that money is not just a medium of exchange, but a tool of distribution that favors those closest to its creation. If this changed how you think about inflation, the next video breaks down how the global debt supercycle is reaching its inevitable conclusion.